Hi, Steve Van Metre here, and welcome to your weekly economic update. We take about 30 minutes every Friday to answer your questions and try to make sense of markets that don't really make any sense. That together, we're going to figure them out, become smarter, and become better investors. Now, some of you have asked me to do a podcast, and I have some great news for you. We have the beginning phases of one. So I took the Wednesday video, converted it to MP3, and courtesy of Dr. Chris Dark, who helped me, let me rephrase that, who I was listening to his inaugural podcast, and I found out that he had hosted it on a site where you can host podcasts for free. Now, starting out, it just hosted on Anchor FM, and I think it's on Spotify, but hopefully in the next 2 weeks, these videos or the audio version of the videos will get out to iTunes. I'll let you know when it's out there because I know several of you are more interested in having it on that platform. And apparently Anchor FM does push it out there. So I'll show you, for those of you who are not familiar with what this is, you can go to anchor.fm and look me up by name, and you'll find the very first one in this video will be encoded and put on there this evening, so you can listen to it later if it helps. Now, as far as my friend Dr. Chris Dark goes, you'll want to check him out too. He just had his inaugural podcast, The Bull and the Bear Case. So he took a look at the bull case for stocks and the bear case for stocks, and he is someone I talk to almost every day about some of the stuff going on in the market. So I was listening to his podcast. I was like, wait a minute. Some of these things he and I actually discussed in his inaugural podcast is called Dr. Dark After Dark. Check him out. I think you'll really enjoy him. So let's go on to some things that I want to talk about. And I've got a massive amount of tabs on my screen, and then we'll get to your questions. Let's hit the Nonfarm payroll report today. I actually said last night, and I thought, well, this will be about a nothing burger because the cutoff was the 14th of last month, really before any of the layoffs started and the unemployment claims went up, and before anyone was really panicking and getting shut down due to the coronavirus. And lo and behold, minus 700, I think 710,000. Wow. And yet people were stunned by it. I was stunned, but in a different way. I knew this was going to happen at some point. And I want to show you why I knew that. And let's take a look, because every time the Fed eases, it causes loss of jobs. Now, you wouldn't think this. And just so you understand, I am an equal opportunity offender. In today's video, I will pick on the Fed, maybe Congress, and the White House. I don't care who's in office in any of them. I'm going to pick on all of them. Not because I don't like them, because of what I want you to understand is the people on top of the system, who you would think understand the system, do not understand the system. And that, as an investor, can create opportunity when you know they're making mistakes and how to take advantage of them. So let's take a look at the Nonfarm payroll report, which I'm pulling off the Federal Reserve database, the St. Louis Fed. And so you see all employees told Nonfarm, and you see this massive just collapse here. Now in the background, I've got 3-month Treasury bills, which is effectively the federal funds rate, because the federal funds rate on here doesn't go way back. I'm sure there's a version that does, but the current one does not. And you can see anytime the 3-month Treasury yields fall, well, guess what happens to jobs? They go away. And let's zoom this into more modern times so you can see. It becomes very obvious. And I've been saying since earlier, this time last year, this recent increase in payrolls made no sense. Because when 3-month yields roll over and head down because the federal funds rate pulls them down, the number of jobs vanishes. Now, if you were in charge of the Federal Reserve, I just want to point out the idiocy of this. Did I say that correctly? The stupidity of this. If you were in charge of the Federal Reserve and you knew easing caused people to lose their jobs, you wouldn't ease. But there it is. Plain as day. Now, is this probably more than I would have guessed all at once? Yes. But the fact of the matter is, if you strip the coronavirus out of this, it was inevitable that the payroll growth would turn into payroll loss, as we've seen. And I expect this to get much, much worse. Again, who would have known? Well, you would have. And now you know, because you're becoming the smart money. The smart money knows when the Fed cuts, people lose their jobs. And when the Fed hikes, jobs are created. Pretty crazy. You wouldn't think that, but the evidence is pretty clear. Now let's talk about crude oil. There's a lot of excitement in crude oil. Prices jumping off 20 a barrel, getting up to 30. People thinking green shoots are coming. The market's turning around. Now, remember President Trump, not too long ago, said he wanted lower oil prices. At the time, I said, no, you don't. No. And of course, that was following him saying, I want the Fed to lower interest rates. I said, no, you don't. You really don't want that at all. Even though I understand why he thinks he wants it. Again, people don't understand the system. I understand that he doesn't. It's okay. I'm surprised his cabinet doesn't. They're pretty smart people, but it is what it is. So oil has been jumping on the hopes of a major global production cut. In fact, President Trump, I believe, tweeted today that he was hoping that Russia and Saudi Arabia would cut 10 to 15 plus million barrels a day of oil. Let's put this in perspective. Saudi Arabia and Russia produce 23 million barrels per day. So if they were to cut 15 plus, that means they're going to turn everything off. Not likely. Not likely. So oil was jumping on some really misinformation. Now, in terms of spinning this back to world dollar liquidity, it's no surprise oil prices are falling. It's no surprise to me if they go back to 20 or below. Wouldn't even shock me if they went to zero at this standpoint. There's not a lot of storage, and the world is estimated to be, in terms of demand, down 20 million barrels a day. So whatever storage is out there in the market, it won't take a whole lot of time before it's filled. So one of the challenges you have here is I heard some rumors that President Trump might shut down all the oil platforms in the Gulf of Mexico due to concerns of the coronavirus spreading. Obviously, there's going to be some things that may need to be done to try to boost the price of oil. Saudi Arabia has come out and said, hey, we're willing to cut as long as everybody shares equally, which nobody wants to, so that's probably not going to happen. So here's the double-edged sword. In the United States, we need at least 50 a barrel, ideally 60 plus a barrel, to keep the oil industry humming along. If oil prices were at 80 to 85 a barrel right now, the U.S. economy would do very, very well. In fact, the higher the oil prices, the more they're going to explore, the more they're going to produce, the more jobs they're going to create, and the more that money is going to flow through the economy. From a world dollar liquidity standpoint, it's terrible because world dollar liquidity says we need to buy foreign produced oil to cycle the dollars through the global system. So what happens when you contract world dollar liquidity, as the Fed did, there's only one solution, and that is everything needs to shrink down. Oil prices, interest rates, consumer prices, home prices, stock prices, everything needs to contract down generally below the level of dollars in the system to bring back demand. That's what has to happen. So we have a problem now. Oil is trying to contract, as I said it needed to. Stock market is working its way down. Interest rates are headed down. Everything is doing exactly what it should do. And we need to let it happen. See, the faster you just let the system fall apart, and I know I have a lot of clients and a lot of friends that work in the energy sector, so I'm not picking on them, but this is the fact of reality of the system we have to work with. The game has been played. The Fed already did what they did. They can't undo it, although they're trying to. The only solution is to let the economy rapidly contract, let places go bankrupt. Now, I mean, you can exclude the coronavirus effect on all this, but the faster things go bankrupt, so healthy companies can snatch up these companies, their assets, their employees, at pennies on the dollar compared to what's going on now, the sooner we can heal. The longer we try to fix the problem, the worse it actually gets in the end. So from a world dollar liquidity standpoint, we need oil prices to tank so that way demand can come back. If someone could say, hey, at $1 a barrel, I can come up with an idea and make money and buy oil, great. If that's the price it has to be, that's the price it has to be. I don't know what it is. I just know that's what needs to happen. Now, if we try to push the price of oil up, let's say the president's successful. He meets with the oil industry, he gets massive production cuts, and they drive the price of oil right now back up to 50, 60 barrel plus. Then you say, well, it'd be great for the energy sector. Yes, it'll be terrible for everybody else because the energy sector is not going to rush out and hire a bunch of people when the unemployment rate is skyrocketing. And if you're on the unemployment line, and at some point you're going to either go back to work or have to go find a new job, the last thing you need is higher oil prices, because when you got to fill up your car and you got to buy things and do things, it's more expensive and you don't have the income. That's the double-edged sword. The proper solution is, hey, the Fed made a giant mistake that they don't know they did, nor will they ever admit. Let the thing fall apart. The sooner it crashes, the sooner you can rebuild. Well, we won't do that. So we'll probably find out next week that a whole lot of nothing happened in the production or cut of production from oil. Maybe they'll get a few million barrels from everybody. At the end of the day, if Saudi Arabia's game, that means U.S. shale and U.S. producers have to cut production. They're in no position to do that. Remember, monetary policy is not fun, and it's often done wrong. All right, let's get to your questions. First one up, the dollar liquidity cycle seems like a bad deal for foreign countries and a great deal for America. It is. That is absolutely correct statement. Since foreign countries give us goods and we give them nothing. Yes, we do give them something. We give them worthless pieces of paper called US dollars that if they ever we ever stopped using them, they're entirely worthless. And we give them our debt, which we could say is also entirely worthless. What a great deal. Is that correct? Yes, it is. If it is a bad deal for them, why are they participating? Because we won World War II. Yeah. If you look at, one of the reasons we have world wars is to finally find out who's going to be the reserve currency. To the winner goes the spoils. You ever wonder why we have the biggest military in the world? Do you wonder why we don't let some of our allies have military forces like we do? Do you wonder why we spend so much time making sure no one else gets big and bad and comes after us? Because we want to make sure the dollar stays the world's reserve currency. If we go down, guess what's going with it? Yep. All right, next question. Can you explain this new leverage ratio tweak? Probably not accurately. And how it impacts long-term treasuries on the next show? I don't understand it. So what is the question about is this press release here. The Federal Reserve Board announces temporary change to a supplementary leverage ratio rule to ease strains in the treasury market resulting from the coronavirus and increase banking organizations' ability to provide credit to households and businesses. So the last piece here, to increase banking organizations' ability to provide credit to households and businesses, is the key goal, is to increase lending. The Fed's goal, if anything they do, whether it's lowering interest rates or changing policies like this, is to increase lending. Now, there was an article on Zero Hedge, and just so you know, I do enjoy reading Zero Hedge, but I do not read all of their articles. But the ones I particularly enjoy are the ones where they cover things like that, because there's somebody who writes for this who is much smarter and much more connected in this. And they said in this article, on April 1st, in a groundbreaking move, the Fed excludes treasuries from leverage ratio rule. Here's what it means. So it requires banks to hold a minimum of 3% measured against their total leverage exposure. That's the current rule. So that got changed, if we go down to the bottom, to they can temporarily decrease their Tier 1 capital requirements of holding companies by approximately 2% in aggregate. The purpose is to get them to lend more. Now, the question is, are they going to lend more? The reality is right now, the only people that want to borrow are corporations who have been buying their stock back, who have no money, who are worried about going bankrupt. So they're yanking their credit lines. Nobody is out now building buildings and doing a lot of things and demanding credit. Now, the author of the article, who is anonymous, did think that this could lead to banks buying more treasuries and selling them to the Fed as a profit. Is that possible? Absolutely. Who knows how that goes? So let's see. Where do I want to start? Oh, yes. Let's go to the assets and liabilities of all commercial banks. Great questions. Send me some more and we'll answer them in next week's videos. So as we look at what's going on with the banks this week, we can see their treasury and agency securities increased quite a bit by 27 billion. Yeah, 27 billion. Mostly in mortgage-backed securities, which jumped dramatically by looks like about 50 billion. And they shed some of their non-mortgage-backed, which are treasury securities. And why did that happen? Because the Fed's buying 60 billion of these things a day. Now, next week, they're going to drop that to 50 billion. Is that a major concern if you own treasury bonds? Not at all. Because they're still buying 40 billion of mortgage-backed securities, and the banks are buying massive amounts of mortgage-backed securities that they're probably going to flip to the Fed. Look, as long as the Fed's buying at $1.8 trillion a month is what their current pace now is, you got the biggest buyer in the world buying up everything. Let's take a look at the lending data. Big jump in total loans and leases, and no surprise, it's coming right out of commercial industrial loans, which jumped almost 200 billion in a week as corporations yank on their equity lines. We see commercial or residential total real estate loans jump by 20 billion, with residential loans rising. Of course, it makes sense because consumers are refining. If you think rates are low now, just wait, they're going to get a lot lower. So if you look at just this lending data, you would think that there's a massive boom in the economy until you get down to consumer loans, which contracted by 10 billion. So you can see credit card spending drop, and other loans such as automobile loans were virtually flat. So not a lot of demand from consumers. Let's take a look at our PowerPoints. So the M2 money supply, the growth rate is up to a staggering 12.24% from a year ago. The 6-month rate changes at 8. The 3-month rate changes at 6 and rising. Now, why does this matter? Well, it matters a lot. And let me pull up the chart on that. There we go. And what you see here is the money stock measures that go into that data. So we want to look at institutional money funds, because you can see institutional money funds is going straight up. And what we're seeing in the money supply is money going into money markets. This is from your brokerage accounts, IRAs, 401ks. Money is going into cash. And as we've seen before, and is worth looking at again, when you overlay 10-year treasury yields, which is very easily done, we'll stick that on the right so it formats correctly. And we go back over to the money in money markets and invert it. Ta-da! There it goes. What you find out as money is pouring into money markets, guess what? It puts downward pressure on yield. So anyone that's saying, no, interest rates are going to go up, interest rates are going to go up, not just yet, not when you see this kind of money pouring into money markets. So that's one important reason to look at this chart. The second one is, as this money comes out of money markets, where do you think it's going to go? Back into stocks. It kind of tells you where the bottom of the market is. So if we go in here and we remove treasury yields, and let's go back and add Wilshire 5,000. And stick that on the right so we can see it. And there you go. Money flowing out of money markets is your bullish indicator for stocks. Pretty cool. That's why the money supply matters and why interest rates are not bottomed out yet. Now, the next couple charts aren't going to be too surprising. Real estate loan growth, now it's up to about 5% on a year-over-year basis, but not huge changes. We're seeing 2.95% rising on the 6-month rate change, 1.71 on the 3-month rate change. Is this important? Yes, but is this showing us a huge demand in the real estate sector? No. All the lending growth is coming out of commercial industrial lending, which has gone vertical. And the growth rate is up to 16.66% from a year ago. Staggering. I mean, I don't think that we've ever seen this before. And that's taking loans and leases at all commercial banks. The growth rate's up to 9.76. This is totally skewed by commercial industrial lending. But the key thing is it's not coming. There's no consumer demand because credit card growth rate is down to 3.56% from a year ago. So we can definitely see that consumers are not driving this. This is panic by the banks. So let's get that out of the way. Whoops, don't want to. Oh, you know what? I did not mean to close that, because there is something I do need later. So there we go. All right, back to all of the slides that I've got, or the browser tabs. All right, for those of you who like leveraged ETFs, this hit zero hedge today. Market zero, triple levered short oil ETN crashes to complete loss. And for those who are invested in this, in an unprecedented spike price along with a record super contango have left the Velocity shares daily 3x inverse crude. So if you were triple short crude, you now lost all your money, because investors who buy the value of the ETN will be zero on April 2nd and on all future days. Investors who buy the ETN at any time at the price above zero will likely suffer a complete loss of their investments. So there you go. That is the danger of this. So you can lose all your money real fast. And at its peak on March 18th, this fund was up a stunning 978% year to date. And now, and it's gone. And you're at zero. So there you go. Be careful with those things. Let's take a look at the liquidity conditions from the NASDAQ McClellan Summation Index. Remember, it tried to bounce. We saw it bouncing with stock prices. In the past, this has given us an indication there was a buying opportunity coming into stocks. If this rolls over and heads lower, you can forget that opportunity. It will be gone. So right now, it's not showing us quite the bottom that we would want it to show to get out of bonds and into stocks. So that's out. Let's continue on our look at charts. The labor force participation rate obviously is crashing as people hit the unemployment lines, and that takes a velocity of money and slows it down. In fact, arguably the velocity of money, speed at which it changes hands, was already indicating that the labor market was running too hot and would need to come back down. You can see these two have a very nice relationship. Let's continue. A question that I got was, how will we know that interest rates have bottomed? Great question. They bottom after a recession. So here's 10-year treasury yields. You can see the shaded lines are recessions. You can see it bottoms after that. It usually bottoms during it, and then there's a second bottom after. So if you missed the first one, there's always a second one. And I think I've given you a ton of information on how to find out where that is. I mean, you can look at the flows coming out of money market accounts is real good as well. And let's see, did I save? Yes, I did save that. Okay, cool. Wanted to make sure I had the chart I was looking for. Next, how do we know consumer prices are headed down? Well, I think they're headed negative on a year-over-year basis. And if you take a look at crude oil, which is a big part of the consumer price index, and I've overlaid the year-over-year rate of change of the CPI, and you can see that in the next month or two, consumer prices should crash. Based on the Fisher equation, it tells us that should be a great big move higher for bonds, as people realize that bonds are, instead of having a negative real return, have a positive real return. Let's continue. Remember, I was asked for charts. You got them. Let's go on to total assets at the Federal Reserve. And so you can see the effects of quantitative easing 1 here, QE2 here, and QE3 of old, and now QE eternity or infinity or whatever we want to call it. Now I've overlaid in red U.S. Treasury yields. And it's really easy to see where that first bounce will be in yields, and or first bottom will be in yields. And if we take and invert the assets at the Fed's balance sheet and flip them upside down, there we go. What you find is that when the Fed stops its first round of easing, yields bottom shortly thereafter. And usually it's the Fed is stopping because it breaks the back of the short sellers. It gets the easing it needs by interest rates falling. So with the Fed running $1.8 trillion a month of easing and no indication that that's going to slow down, maybe they're going to taper a little bit, but it won't stay tapered for too long, because they're probably going to have to turn it back up. It tells you that interest rates are headed lower. And if you want to watch the Fed, they'll give you the indication about when it's time to get out, because when interest rates finally are low enough to ease financial conditions, the Fed will back off the pedal. And with our last chart for the day, the question is there a relationship, this was my question, between the dollar and 10-year treasury yields? That's a great question because we are in a dollar liquidity shortage, and it tells us the dollar is likely to rip a whole lot higher. Now, again, I do not trade currency, so I'm not the expert on that, but many people say that the dollar is going to go higher and there's an opportunity there. I feel that bonds are a much easier way to go, but you look at the two and you don't say, well, I don't quite see the relationship there. Well, let me show you what happens when we invert the dollar. And with a little magic from the Fed's charting system, there it goes. So you can see in recessions, when the dollar peaks out, guess what? Interest rates go down. So the fact that the dollar is in rally mode, looking to break higher, tells us interest rates are headed lower and bond prices are headed higher. So see, it's pretty cool when you look at all these different relationships. You know, as an investor, you have to build your thesis. So as a professional money manager, and we probably will have a video where I talk about this, I think it'll be important. Like, how do I go about and establish what it is I'm going to do for my clients? What is my process? How do you do that? You know, you have to have your initial thesis, you have to have your exit point, and then you have to know who you're going to sell to, and then you have to have your next destination mapped out. So you already know. You know, somebody said, well, when are you going to sell bonds? I already know when I'm going to sell them. I know who I'm going to sell them to. I'm going to know where I'm going next. I already know. I just do not know the day, but I know, and that's what you have to do. And we'll talk about that at some point. Not exactly what I'm going to do, but just the process of what I go through. Let's take a look at some charts. The S&P 500. Now, the market's left some open gaps here. You see there's a gap between this closing value and the opening the next day. There's a gap way up here near the peak and a little gap here, a gap kind of in here. And investors are really hoping to see these gaps get filled. They want to see the market run all the way back up to 3,300. I don't think that's going to happen. I said that this rate cut in here would act kind of as a ceiling. You can see the market try to go up and just couldn't make it, ran out of steam and came down. Now, what doesn't make sense is yesterday you hear 6.6 million people file unemployment claims and the market went up. And that's pretty much not making any sense. It is what it is. Let's take a look at 30-year yields. And you can see the next major line of support in yields is right at 1.2%. And you break this, and there's no reason after that there isn't a run at the all-time lows and possibly even lower. Because what's happening here is we're seeing sellers trying to keep yields up. Now, why would they do that? It's very, very simple. If you are long stocks, right, you're bullish stocks, guess what you need yields to do? You're bearish on yields. You need them to go up. So that's why you see the market's trying to go higher, and they're trying to push yields up by shorting interest rates. Not going to help, because in a dollar liquidity shortage, you need lower interest rates to get the system fixed before you can get higher interest rates. So they're going to be on the wrong side of this trade. And you can see it fairly evident in TLT. And the reason I like this, it's the largest traded bond ETF. And you can see I've moved this purple line. We had a dotted line the other day. I moved it up here. This is about where 1.2% is. And you can see, to me, this is really the last line in the sand. We got through 1.3, which was where this dotted purple line was. There's a lot of resistance, overhead resistance, where sellers had been. And then we got up to 1.2. We found sellers. And we kind of gingerly got near 1.2, found sellers. Got back up to one near there, found sellers. And then today we got up and through 1.2, and boom, sellers came in. Now that it happened on the news of the Fed, and we can look and see when the Fed actually kind of announced that they were going to taper their bond purchase program by a whopping $10 billion a day. So instead of doing $100 billion, we're going to do 90, and 90 is still an insane amount, so nothing to concern itself with. But the fact is, on that news, bond prices only went down this far and then went back up in after hours trading. And that, to me, is significant, because what we're looking for in technical analysis here is called seller exhaustion. And the reason is, if you're bullish something, you want to know when all the sellers have run out of desire to sell. And right now they're putting a major line in the sand at 1.2%. Now, is there going to be some potential sellers up in here? Possibly. We do know there was a bunch of computer programs that sold in here that are still out of the picture. And we know there's some money managers who, for various reasons, needed to cut their gains back as part of their models. I mean, that's not a big deal. So there may not be a lot of sellers left up here, but if there are, we can kind of see where they are. And we know that once TLT gets over 181.41, you're really in a new bull market because you're at all-time price highs. So I'm very interested in seeing it break above this. And I believe that 1.2 is pretty much the last line in the sand. Now we can go and look at volume and try to interpret what we see here. This is called a waterfall pattern. Now you have to look at it as here's the top of the mountain and here's the water coming down. And a waterfall pattern can obviously be bullish or bearish. So let's take the bear case where bond prices are going to go lower. In that case, you want to look at volume. And on my screen, I have volume in these cayenne bars. And volume is simply tells us the total number of transactions. Half of these are buyers, half of these are sellers. It's that way every day, no matter what. You cannot have more buyers than sellers. It's not possible. Now, in a bearish picture where we would think the bond prices are going to go down and the buyers are going to be exhausted, what you would look for in the volume is rising volume from the bottom. So you'd see volume going up with the value of the fund. And as you get near the peak, wait a minute, I got that backwards. In the bearish case, you'd see volume starting out very low and then rising into the peak. And what that is telling you is the sellers are increasing the amount of shares they're selling as the buyers are increasing the amount of shares they're buying. And when you get to this peak up here and the buyers run out of steam, the sellers win and prices go down. We're seeing the opposite here where we're seeing trading volume go down. And we know the market is net short bonds because we look at the hedge fund position every Monday. So we can interpret this waterfall pattern based on the volume to be bullish for bond prices. And we can look here and see selling, 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 selling. So we know this is where the sellers are at. Once the sellers are exhausted, who's left? The answer is nobody. And that's where you get the bullish narrative. Let's take a look at the dollar and we'll zoom out and we can see the dollar came down into the support level here between 198.50, found support and is rallying up and looking to break out. If the dollar gets over 103 or 104, then who knows where it goes from there. But guess what it's going to do? It's going to take interest rates down with it and bond prices up as well. And that's how you kind of build your view of where things are going. You can't just look at one thing or two things. You've got to take multiple perspectives and tie it all together. That's how you become a smart money. That's how you understand the markets. And that's what we'll be talking about in the weeks to come. And we'll put this on podcast. You can take a listen to it again. And I will be back with you Monday to take a look at how hedge fund managers are positioned. And you can guess that I'm going to be looking Saturday morning to hopefully find out they're still net short bonds. I'm Steve Van Metre. Thanks for watching. We'll see you Monday. Bye now. The content of this video is provides educational information only, is not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.